Hey, hope you're having a good day. We're here doing a quick live on Facebook. I'm with Stephanie Weeks, and we're also recording this, so this is going to be on YouTube and all that good stuff. But we wanted to go live and talk a little bit about lending real quick and the CAFA Grant program. A lot of people, they'll come to us and be like, what is the CAFA Grant? What does that mean? What does it stand for? So I thought, well, why not better than to bring Stephanie here in to talk with us today and give us a quick rundown. Do you know what CAFA stands for? Because
yes,
I don't.
It's the Capital Area Finance Authority.
It
started in the Baton Rouge area.
There you go. So, and the purpose of that, it's a grant. So what's really nice about this grant is you do not have to pay the money back. But by getting the grant, you're allowed to, the money's being put down on the property. That's what's really cool
right,
about
it's very
it, right?
Cool.
So
right.
You want to just kind of explain a little bit
Sure.
about?
So what's very unique about it is that the money is going toward down payment, which is wonderful. So even though you're essentially doing almost 100% financing in some cases, you don't have zero equity. You actually typically have around 3% equity at least, which is great.
Mm-hmm.
And the fact that you don't have to pay it back is phenomenal.
Right.
And the fact that you can use it more than once is phenomenal.
Wow.
So if this is around, let's say next year, you buy a home this year, live in it as your primary residence, utilize that, you're selling that home for some reason to go get another one next year, you could use it again.
Wow, that's pretty, I mean, it's really, we've had clients, many clients to use the program, and that's what they love about it. Now, people out there probably saying, well, what's the catch? What's the caveat? What's the difference? And to make a long story short, the deal is in the rate, right? So you'll pay a little bit higher rate, but basically they're giving you 3% to put down on a piece of property. We get the seller to pay your closing costs 99.9% of the time. So, I mean, you're talking buying a $362,000 home for no money out of pocket.
Right, it's huge.
But they're granting you the money. Now, but your rate's going to be higher, so your payment's going to be higher, and you have to qualify for the higher payment, right? But
of course.
You can refinance the property after you've lived there for 6 months.
Yeah, after you've made 6 payments, you could refinance
That's crazy.
if the better rates are available for you.
Wow.
I had a client with around a 680 credit score, bought a $400,000 home, paired it with the grant, had the seller pay closing cost. They got into the house for $1,000.
That's unbelievable.
It's phenomenal. And yes, the rate's higher, but when you pair it with the grant, you actually get discounted mortgage insurance. So the increase in payment is really not all that much.
Right. And mortgage insurance, if you're out there, a lot of you may know, but if you don't, mortgage insurance is basically insurance that the lender takes out on you in case you default on the loan, correct? And the premium that you pay each month, you're paying the premium like you would an automobile insurance premium each month to have that coverage. You're paying the premium for the lender in case you default on the loan.
And so a couple of ideas to think about is that with mortgage insurance, you have monthly, which almost everyone knows about, and you have upfront single, where you pay it one time upfront, drastically discounted of a rate, so that you have no monthly, or you have lender paid, which is another form of just building it into the rate. But so what some people do is they choose to get the grant. They have down payment, but they choose to get the grant, so then their down payment can be utilized to buy out of the mortgage insurance. So now they have a loan essentially with no money down, but with equity and no monthly mortgage insurance.
That's pretty awesome.
It is.
Sounds real confusing, but that's what we're here for. I mean, literally, you can call Stephanie. We'll put all of our numbers and links and all that stuff. So we'll find you the property. She'll loan you the loan you the money, and anyway, you know what I'm saying. So the CAFA grant. Now, as far as qualifying, is there a thing where, like, what if I make too much money or too little money? Is there an income cap or anything that we can or can't do there?
So between now and loans that are locked November 30th, the grant that is paired with a conventional loan, the income limits are lifted. So it does not matter if you make $200,000 a year, no amount is too much.
Wow. That's
as long as you lock in on a home by November 30th, and then you close on that particular home.
Gotcha.
Right?
So you could close 30, 45 days later, but you have to have the locked in on that property.
Right.
Contracted, if you will, yeah.
Right. And what's really cool is that even after that date, when you're pairing it with conventional as an example, so let's say St. Tammany Parish, I'm checking my notes real quick, the income limit is over $91,000. So we're not talking a small amount where a lot of these grants or bonds in the past have been super, super low income.
Right.
There's some parishes where the limit is over 100,000 in income, and it is not household income; it's borrower, which is phenomenal.
That's the big thing.
Yeah,
that is phenomenal. the really big thing is that it is the borrower. So if you're a husband and wife, and your husband makes $90,000 and you're an attorney or doctor or whatever, it doesn't really matter. I mean, if you're making 120 and he's making 90 or vice versa, then basically whoever's on the loan gets to qualify for the loan.
Right.
You can make a household income maybe $250,000, but whoever's income is the lowest, as long as you fall under that cap after November 30th, you'll be able to qualify for the program.
Which is unique as well, because that's not how it's been in the past.
So a lot of people are like, well, wait a minute, why did I want to buy a piece of property and not put anything down? Or think about this. A lot of people have credit card debt, car payments, student loans. We've had people with tens of thousands of dollars in student loans. They'll sell a house, have equity in their home, because you do not have to be a first-time home buyer.
You do not.
You sell the property, take your equity, pay all of your debt off, or most of it, or all of your student loan, or whatever it may be, then turn around and purchase a property like this that you know you're going to live in for the next 4 to 7 years. And you can pay the payment even more so, because now you're not paying all those little bitty nickel and dime, maybe a credit card here or a car note or anything like that. So that's what we have people take advantage of it from all walks and all financial aspects.
Right, it's huge. And so a client that I worked on this morning, as an example, he's buying a house for $220,000. Okay, he said that he wanted to put $20,000 down. Fine, right? Well, what we did was utilize the extra money. Instead of putting extra down, we went ahead and planned to pay off his car, which that same $7,000 down on the house would have saved him about $35 a month. Instead, we're paying off the car for $439 payment.
Right.
So he just freed up $400 a month to knock out other debt, or to pay off his house faster.
Right.
Build a savings, save for your kids' college, whatever the case may be.
And here's the thing too, really, like for example, I know I've seen it where the rate, and correct me if I'm wrong, and you can quote some rates if you want, but what we're seeing is, like, for example, if the rate today is 4.25%, then in this CAFA grant, you're probably more likely to pay, what, 5.25%, 5.5%?
It's not quite that different. I mean, some that I priced in the last week, which were low down payment programs, right? So we're high 4s, and then the CAFA, depending upon, because there's 4% assistance, there's 3% assistance, there's no assistance, which can be utilized for a lot of good reasons as well. But yeah, so usually around a point, or not quite a point higher than the going rate, which is not too bad.
And what I find fascinating, and a lot of you may be watching this, and we've been in the business a real long time, and we've seen rates. 22 years in the business for me, and the reason why I say that, I've never, ever been in this. In 22 years, I have not been in the business and seen an interest rate higher than 8%. Like it's been, and that's still really good. So what happens is people are so hung up on, because they do remember, man, I remember a little house I bought in Covington. You did the loan for Rachel and I. We had 2.99% on a 15-year note. And I was like, man, that'd be nice to have that back again. But, you know, you can't keep looking in the past. You'll jump off a bridge. At the end of the day, you look at the difference between a 4.25% and a 5.25% payment. It's really not a whole lot of money.
Right. It's not huge.
It's not a whole lot of money. And in retrospect, that if the rates are 4.25%, 4.5%, and you're going to have to pay a 0.5 point or 0.75 percentage point more, you have to remember too, you can refinance that property. So you can buy a house any other way that you want to, 1,000 different types of loans. This is a pretty cool way to free up some debt and purchase a property. You don't have to be a first-time home buyer. I wish this was available when I was a first-time home buyer, because I remember digging and scratching and change and trying to find anything. I wanted to buy a house, when I was 21 years old, and man, I remember I had to have, it cost me like $6,000 out of pocket.
Yeah.
That was decades ago, So.
It's very cool, very unique, and I've been doing this for 15 years, and I never felt passionate about any of the other bonds or grants that I've come across over the years, because the way that I am is I won't sell something if I wouldn't do it myself, right? And so I kind of nitpick everything to figure out, okay, what's good, what's bad,
right? Does
the good outweigh the bad? And so it was kind of funny, because Ashley, who helped with this program in the beginning, she approached me, and I drilled her for over 6 months.
Yeah, I remember you telling me that.
To try to find,
because it's like there's got to be
to make sure
something,
right. to realize that it is a really fantastic program. And so now I'm super passionate about it, because in the past, you had to wait in line for a bond. Well, that made you at a disadvantage as a buyer when the seller didn't want to wait, right? Or let's say your loan was approved and then you had to wait in line and the money ran out. Well, too bad for you. I didn't like that. Didn't think household income was fair. I didn't think first-time homebuyer was fair. I didn't think paying it back was fair. You don't know where you'll be in 5 years to live in a home for 5 years. So to have all those things on this is great. To not have those things.
The cool thing about it is that it's fed and it keeps going because of the
because it's in the rate.
It's
right,
in the
so
rate.
the money does not run out as long as there's a rate.
As long as there's as long as literally people are still using it, it feeds. So if you're a home buyer and you bought your house that way, then if you refer someone and they buy a house that's how it keeps going. That's how it keeps circulating. Because most of them, we've all seen them come and go. It's like, well, they ran out of money, or they did this. And look, they're the ones. I tell people this all the time. At the end of the day, the banks can control all of this. They're loaning you the money, so they can control those rates, and they can control like the limits, because there used to not be a limit. Now they've put a limit on it.
Right.
But still, though, the fact that it does not have to be your household income, it only has to be whoever is
borrower income.
Borrower income. Borrower income.
Right.
Is there anything else? Anything I missed out there? Or?
I don't think so. I mean, I think we covered everything, and I promise you I've tried to shoot every hole in this program possible. But it's something even I would do myself.
I was
honestly.
hesitant, and I mean, like we all are. If something seems too good to be true, we've always heard it probably is. In this case, the only thing that's
negative is a higher rate.
Is a higher rate.
Is it really negative though? If you're saving your money,
I mean,
or you don't have the money in the first place, so you don't have the option,
right?
Or you don't qualify for a 100% loan.
Well, and you have to.
It's really not necessarily negative.
Well, and if you look into the future, if you think, okay, what about if the rates go up? What if I don't purchase today? I can't get that house today. The rates go up, home values go up. In our area here, in the Metro New Orleans area, we see an average increase in property values around 3.5% to 4% per year. So you have inflation, you have property value increase, and then you have the rate. The rate's going to go. Look, they're going to go up. I mean, we already see them. They've went up. So if it's something that you want to jump on now as opposed to later, it can be. But I'm not trying to push you on anything. You don't have to buy a house, but we're here to help if you decide to. So.
Absolutely. And if you have any questions, just call either one of us. We can help answer any of those questions at no cost or obligation.
I'm Wayne Turner. I'm with Turner Real Estate Group.
And I'm Stephanie Weeks.
Thank you so much.
Thank you.
Have a good day. We'll see you.